Are you wondering what the differences are between an ETF and a mutual fund and which one might be best for your situation? Well, in this video, I'll talk about what an ETF is and a mutual fund and some things to think about when you're trying to decide which one is best for you. And be sure to stay until the end where I will share a great tip to help you to be a smarter investor. So let's get started. A mutual fund is basically a basket of stocks picked by a professional. So the great thing about a mutual fund is that it gives you instant diversification and you don't have the risk of investing all of your money in just one stock. And a mutual fund, when you buy or sell a mutual fund, you get the closing price at the end of the day. Here on the West Coast, Pacific time, it's 1 o'clock, and let's say in the East Coast, it's 4 p.m. An ETF stands for Exchange Traded Fund. And just like a mutual fund, an ETF is a collection of stocks picked by a professional. But what's different about an ETF is that it trades like a stock. So you can buy or sell the stock throughout the day and get the price that exists at that time. So with an ETF, you do have more flexibility in terms of the price that you buy or sell it at. ETFs can be more tax efficient than mutual funds. So by holding an ETF in a taxable account, you may generate less tax liabilities than if you held a similarly structured investment in a mutual fund. From the perspective of the IRS, ETFs and mutual funds are subject to the same tax treatment. Both are subject to capital gain tax, and both are subject to dividend income tax. However, ETFs are structured in such a way where the ultimate tax liability is minimized for an investment if you compare it to what the tax implications would be from a mutual fund of a similarly structured investment. So if you have, let's say, an S&P 500 ETF and an S&P 500 mutual fund in a taxable account, the ETF would generate less of a tax liability than, say, the mutual fund. Remember, tax efficiency is only an issue in taxable accounts. So for accounts like IRAs or 401ks, this is not an issue. Most people stick with mutual funds. However, if you are in a higher tax bracket and tax efficiency is important to you in your taxable accounts, then you may want to stick with ETFs. But just because you can buy and sell ETFs throughout the day does not mean that you should. It's important to maintain a buy and hold perspective. If you think that you'll be tempted to buy and sell frequently with an ETF, then stick with a mutual fund. Bottom line, both are great options. It really depends on what's best for you. Now for the great tip to help you be a smart investor. When looking at mutual funds and selecting which ones would be best for you, it's really important to pick mutual funds with lower expense ratios. And I would stick with mutual funds with expense ratios of 1% or lower, ideally even lower than 0.5. And you can take a look at these mutual funds. You can input the ticker symbol in a really great tool called morningstar.com. Just input the ticker symbol and take a look to see what the expense ratio is. Thanks so much for watching. If you enjoyed this video, please hit the like button and subscribe. See you in my next video.